One of the things I think that people need to think about is a strategy where, as you're in your 50s, you start bucketing money. So meaning building a bucket of money that's made out of cash, cash reserves, and less risky investments that will provide for 2 to 3 years of your retirement paycheck. So that when you retire, that's the money that's going to pay you in retirement. And then you can have more money invested risky. You never want to take money out of a market to fund your retirement.
So let me ask you two questions. Where do annuities fit for the 50-year-old? Where do target date funds fit for the 50-year-old?
Okay, let me start with annuities. After the 2000 market corrections and the tech, downfalls and all of that, and particularly after the Great Recession, the boomers and retired people started saying, I want my money to grow, but I don't want to lose any money. And so the great thing that annuities do is that they provide an ability to get an income stream for your essential expenses. So how great would it be if you had an income stream that you knew you could cover your housing, your food, that you'd never have to worry about again?
These are not variable annuities that are an investment product. These are the sort of single premium, those kind of products.
Single premium, and you get a rate of return that can go up but never go down, depending on what the market does. They have expenses in them, but you're paying for a hedge fee. Maybe right for people, maybe not, but something to look at to cover the essential expenses. So definitely a good portion.
Some people love them, some people hate them.
A lot of people hate them because they don't understand them or know enough about them. Definitely worth researching.
All right, target date funds.
Okay,
where do they fit?
Target date funds. Target date funds are good if you don't have a lot of money and you want to just start investing and you want to put things on autopilot and you're not getting a lot of advice. On the other hand, they're very, very cookie cutter. So your risk tolerance may change, but they're going to auto change your risk tolerance. So as you move into a different, risk, when you go from 30 to 40 or 50 to 60, they'll move you, but you may not want to be moved. One other very important point, 401ks auto default are target funds. So if you have a lot of money in a 401k and you've auto defaulted, you'll be in that target fund. You don't want your non-qualified money in a target fund as well.
So let me ask you something. Is there a number? If I make, let's say, $150,000 a year, is there a number that I should have in mind as my investment corpus for the day I retire? Is it 10 times my current salary? Is it 20 times my current salary? Do you do that kind of game theory?
Do you want to sail around the world on a yacht, or do you want to stay home and play ping pong?
I want to eat Cheez-Its.
Well, if you want to eat Cheez-Its, it's going to be... So, that's really the answer. Some people want to play golf and join a country club.
Right.
Other people want to play ping pong, and one's a lot more expensive than the other. So you really, and this is really my biggest piece of advice, we work so hard. Americans, and everybody knows this, the studies show we work harder than people around the world. And yet, we don't spend any time thinking about how to plan for it, right? So you have to plan, especially when you're in your 50s, and take the time to do it, but it's a pain in the neck. But what do we work so hard for? So you have to figure out exactly what you need. All right.